Ready? So for this mock exercise, we're going to take a look at how to report and analyze long-lived assets, particularly intangible assets. So let's take a look at the question. Collins has these transactions related to intangible assets in 2009 for the first year of operation. So the first thing we're asked to do is to provide journal entries to record the above transactions. And part B asked us to reflect or to show the balance sheet presentation of the intangible asset as of December 31st. So the first transaction on January the 2nd, we purchased a patent with an estimated useful life of 5 years, and the legal life is 20 years. Okay, so the first journal entry is January 2nd. We're going to record debit patent, which is an asset, credit cash. We're assuming all transactions are cash. Now, just remember one thing is it says the estimated useful life is 5 years, but the legal life is 20 years. So you always have to determine what is the appropriate period of amortization or depreciation. In this case, because the useful life is only 5 years, although the patent may have a legal life of 20 years, you're going to amortize it based on the usefulness of it, which is only 5 years. So something to note, because we're going to actually record the amortization expense in December 31st, so we're going to have to remember that this patent has 5 years. So maybe I'll just write the word 5 years. Economic life. Just as a reminder that this asset has to be amortized 5 years. On April 1st, this is acquired another company and recorded goodwill of $300,000 as part of the purchase. So here we're not really provided with how the goodwill, or we're not asked to calculate goodwill, but normally goodwill is something that a company, it only arises when a company buys another company, whether it's an asset purchase or a share purchase, and they end up paying more than the fair value of the net asset or the fair value of the business. And that's what goodwill is. And so here, because it was an acquired, in other words, they paid for it, then we can record goodwill. Internally developed goodwill is not recorded on the books of the company. So if a company developed its own brand, developed its own reputation, for example, that's called internally developed goodwill. That can never be recorded on the books of that company. But if another company buys, let's say, that company that has internally developed goodwill, if they paid more for the fair value of the net asset that they purchased, then you can create or you can calculate goodwill. So in this case, we're going to assume on April 1st, that's what Collins did. They bought a company and they paid more for the fair value of the net asset or shares of that company, and they paid an extra $300,000 and they call that goodwill. So that's an asset. So debit goodwill, credit cash for $300,000. On July 1st, what happened? They acquired a franchise for $250,000. The franchise has an expiry on July 1st, 2016. So the franchise has an expiry of July 1st, 2016. Okay. So we bought it on July 1st, 2009, and it expires on July 1st, 2016. So that would be 7 years useful life. Okay? So July 1st, we're going to debit an asset called franchise, credit cash. And clearly these are assets because without the franchise agreement or the fee, we're not able to generate revenue. So part of it is we're going to take this asset called franchise, and we're going to spread the cost of that asset over its useful life. And usually the usefulness of it is ability to generate revenue. So in that case, we're going to debit franchise asset, 250, and we're going to credit cash 250. Now, because it was bought from July 1st, 2009 to July 1st, 2016, that's 7 years. So that's what we need to be mindful of, the fact that we're going to amortize it over 7 years. Now, on September 1st, incurred research cost of 150. So September 1st, we need to decide whether research cost is an asset. Now, basically, our standards are clear. Our standards indicate that all research costs are expensed. So expense when we incur the cost. So there are no exceptions to that rule. So we're going to debit research expense. I'm going to put the word operating expense, just to be clear. And that's because we have a standard that says all research are expensed. Okay? And essentially, because it's difficult to measure the benefit and difficult to measure the usefulness of this cost called research, that's why our standard is clear, that says any research costs associated with company, researching for, let's say, growth or opportunity, or perhaps researching a new development of technology, etc., those should be expensed when incurred. Now, on April 30th, it says incurred development cost of $50,000. No marketable products have been identified yet. And again, this is the key. So development costs, you do have an option to capitalize as an asset. And you have to meet certain very stringent standards or criteria to capitalize this asset. Without going into details what those stringent criteria are, one of the criteria is definitely has got to do with whether the development translated to some sort of product that they're going to sell. And in this case, we are specifically told that there's no marketable products yet to be identified. In that case, development cost, in this case, although we do have an option, should be expensed. Development cost expense. Again, it's an operating expense for $50,000. Now, let's say the following year they're going to incur more development costs, but perhaps as they do more development of a particular idea into a product, into some sort of prototype, and they're able to meet other criteria within our standard, that is when we can capitalize all those costs. Now, does that mean that can we go back to this year, and because we expense it, can we go back and actually capitalize those development costs that we've expensed? The answer is no. Because in 2000, in this case, in 2009, let's say in 2010, we're able to develop the product or the idea, the prototype even further, and we're able to meet those various criteria, then that was actually met at that particular future period. So in 2009, these costs should be expensed because we never met that criteria in 2009. We can't go back and capitalize them because at the time that we expense them, we never met that criteria, those criteria. Now, on December 31st, we're asked to record the amortization. So why don't we do that? So first of all, we've got a couple of assets. We've got patent, 5 years. So why don't we do that? So debit amortization expense. I'm going to short form that to AMORT expense. And that is $40,000 divided by 5 years. because we bought it on January the 2nd, we've got the entire full years of amortization. So that's $8,000. Now, goodwill. Goodwill is not an amortized asset. Goodwill is only tested for impairment. So, given the fact that if you look at the second transaction, this is tested the intangible assets for impairment, recoverable amount exceeds the carrying amount in all cases, goodwill is not an asset that we amortize because it's difficult to determine and allocate the period of benefit and to what extent the benefit is for a particular year. So goodwill is not an asset that we amortize. It's not like patent or franchise. But we need to test goodwill for impairment. And there is a very specific testing, and it requires us to look at the recoverable amount of this asset. And we compare the recoverable amount against the carrying value and to see whether there's an impairment. So in this case, we're going to assume, and then the question actually told us that the recoverable amount exceeded the carrying amount, so we don't have an impairment test. The next asset is franchised. So we're going to debit amortization expense, and this is patent. This is franchise. And here, and we know it's 7 years, so it's $250,000 divided by 7 years. But remember, we bought it on July 1st. And because July 1st is 6 months in 2009, we're going to prorate the first year of amortization times 6 over 12, and that gives us $17,857. Okay? So it's imperative for us to remember when these assets were purchased. The date matters because, particularly for straight line amortization, we have to determine the period in which we have to prorate, particularly for assets that were not purchased at the beginning of the year. And that is the case for franchise. And the corresponding credit is we're going to credit a cumulative amortization, patents, and this is a contra account to the patent cost, and we're going to credit a cumulative amortization franchise. And that is our journal entry for December 31st. Now, how do we present this on the balance sheet? Well, normally, under long-term asset, so Collins Limited, partial balance sheet, as at December 31st, 2009. Under long-term asset or long-lived asset, we have a section called intangibles. First thing we're going to list is patents, and that was $40,000 less accumulative amortization. Then we have franchise. Less accumulative amortization. Then we have goodwill. And that gives us a total of $564,143 total intangible. And of course, before this section, you would have your tangible assets listed first. Okay? Thank you.